Forex leverage is a tool that allows traders to control a larger position with a smaller amount of money. In simple terms, it's like borrowing money from your broker to increase the size of your trade. Leverage can amplify both potential profits and potential losses, so understanding how it works is essential for managing risk in Forex trading. When you see leverage described as a ratio, like 110-150 or 1 to 100, this represents how much more you can trade than what you have in your account. For example, if you have $1,000 in your trading account and your broker offers 1:100 leverage, you can control up to $100,000 in the Forex market. This means you're only putting down a small portion of the total trade size, called the margin, and your broker covers the rest. Here's a simple example. Let's say you have $500 in your account and want to trade the euro to US dollar currency pair with 150 leverage. With this leverage, you could control a position worth up to $25,000, even though you're only using $500 of your own money as the margin. If the trade goes in your favor, you can earn much more than if you were only trading with your original $500. However, if the market moves against you, your losses are also magnified, which can quickly lead to substantial losses. This is where the margin call comes in. When your trade moves too far against you, your broker might ask you to deposit more funds to keep the position open. If you can't, they may automatically close your trade to limit further losses. This is called a margin call, and it's a way for brokers to protect both you and themselves from excessive risk. It's also important to understand that different leverage ratios suit different trading styles and risk tolerance levels. For example, a 1:10 leverage ratio is much lower and safer than a 1:100 ratio. High leverage, like 1:100 or even 1:500, can offer big opportunities, but it also comes with high risks. Many beginner traders use lower leverage, such as 1:10 or 1:20, to start safely and limit their potential losses while learning. Let's put it into perspective with an example. Say you're trading with 1:100 leverage, and you enter a position worth $100,000 with only $1,000 of your own money as the margin. If the currency pair moves in your favor by just 1%, you'd make a profit of $1,000, effectively doubling your money. However, if it moves 1% against you, you could lose $1,000, wiping out your account entirely. This is why it's crucial to use leverage carefully, especially as a beginner. Many experienced traders use risk management strategies alongside leverage to limit their exposure. For instance, they might use stop-loss orders, which automatically close a trade if it reaches a certain loss level. This helps protect them from unexpected market swings that could lead to large losses when trading with leverage. In short, leverage in Forex trading is like a double-edged sword. It can boost your profits, but can also increase your risk significantly. By choosing an appropriate leverage ratio, using risk management tools, and understanding the impact of margin, you can use leverage to your advantage while staying in control of your potential losses.